All right, everybody, welcome to essentially the final building block stage of the trade speakeasy, Jade Lizard Room. And I say that because when we complete today's class, when we complete today's conversation, as long as we understand all of the concepts that we've talked about for the last couple months when we were together, you'll have every building block necessary to start to dive into more advanced strategies. So to everybody who stuck with us this far, I just want to say thank you. I want to say congratulations. It is a lot. It's when you're learning options, it's a whole new language. But if you've stuck it out, if you've made it this far, if it makes sense to you, this is a really, really phenomenal foundation for your options journey and for learning how to trade and strategize and build complex spreads. All right. Before we get any further, we always have to make sure that we remember to trade responsibly. Past performance, whether actual or indicated by historical tests of strategies, is no guarantee of future performance or success. There is a possibility that you may sustain a loss equal to or greater than your entire investment, regardless of which asset class you trade. Therefore, you should not invest or risk money that you cannot afford to lose. Options trading is not suitable for all investors. Today, we're going to be talking about short strangles. So we talked straddles for the last 2 weeks. We're actually going to skip the long strangle. We're not going to discuss long strangles. They're I personally don't trade them. Suzanne doesn't trade them. If you're curious about them, probably in about 2 minutes as I get into this presentation, you'll be able to say, oh, short strangle can change to long strangle. You'll understand how to do it. If you have questions about them, you can always reach out, but we're not going to be focusing on those in this class. All right, but the short strangle, we sell a call and a put, both of them out of the money. So remember when last week when we talked about short straddles, we were in the money. We were right there at current price. Now we are expanding above and below. All right, so we're trying to keep our strikes way, way, way as far away from action as possible and still collect a premium from selling them. And we're doing this while we're holding shares or a long position in the same underlying. And so by holding those shares, it's protecting us from an exponential loss, because whatever's happening to the option contract is also happening to the shares that we're holding, but more on that later. Market landscape is expecting a range-bound movement, or there's an important event or catalyst that has artificially inflated volatility. So we're going to be more actually in today's discussion talking about a range-bound example. We're going to shift away from an earnings style trade, but you could take the same type of things that we've talked about in the past about how to study and take this strategy and apply it to previous earnings and see if there's maybe any trade ideas that pop up for you. So to think about the setup, you want to think about selling a short put. Notice that is outside of the implied move. If we're trading at around $100, then we want that short, and the implied move is plus or minus $6. Then we want that short to be at least $6 away. Same thing with the short call. And we're selling a week to a month expiration. All right. Now, as always, I like to, when I'm showing a strategy that is multi-leg, I like to just remind everybody of both sides of it. All right. So very quickly, we remember the put profit and loss scenario for a short put. Remember the profit and loss scenario for short calls. We combine them now. And so notice we'd imagine in this risk profile that that current price is trading in between where short strikes are. And so we have this sort of profit tent that expands on both sides. And all that we're trying to do is hope that price stays within this window in the given time that we have until expiration. And we'll talk about some strategies to not predict, but to try to put ourselves in high probability situations where that's likely to occur. So if we're selling short strangle for volatility events, this is going to look very similar to what we've talked about in the past. It's going to be entry strategies during the volatility event, sell to open while volatility is high and options premiums are inflated. Sell to open with enough time to capture the volatility drop, or sell to open with a higher delta on the side of the drop. This strategy is focused on capturing a drop in volatility, so the strategy may only be open for a few hours or days. Again, I just want to emphasize, we're not going to talk as much about this style today, but if you're interested, go back and practice. And we've talked about how to do that. So I know that everybody who's been with us this whole time, you're fully capable of doing that. What we will focus more on today is the range-bound underlyings. And so the idea here is that you're a trader who is holding shares of an underlying, and you're looking to average into that position. You're holding it for long term, and then as an income generating strategy, while you're holding those shares, every month you're finding ways to put on a strangle. Now, this isn't going to work for super volatile companies you may be holding, but high dividend shares tend to stay pretty range bound, and they tend to be to make more sense to apply a strategy like this. All right, so when we're doing this style of a strangle, we're going to sell to open while volatility is high and options premiums are inflated, not necessarily around earnings, but we are going to try to do it around the market open, because we know that there's going to be a higher volatility premium baked in that's going to drop throughout the day. So we sell to open with enough time to capture the volatility drop. What that means is, if we're selling really close to expiration, the vega aspect of that contract that we're selling is going to be minuscule, because there's not a lot of time for price to bounce around. So we actually have to, when we sell more time, it looks like we're only selling theta, but we're also selling volatility. So the volatility premium is going to give us more bang for our buck if we sell with a little bit more time out. And we're sell to open with enough time to mitigate theta pitching. This strategy can be used as a consistent income generator, and funds obtained can be used to expand the long position during long bullish trending markets. So the idea here is, you're holding shares, you want to buy more shares, you can sell this strangle, take the profits from the strangle, buy another share, sell another strangle, and just rinse and repeat to just continue accumulating shares and accumulating that position. That's the idea behind this. So the setup, income protection or long position. Underlyings with long periods of consolidation benefit from two short positions, i.e. theta neutralization. So what that's saying is, we're selling above and below, and what that means is, no matter what price does, we are getting a theta benefit from both sides. Both sides are paying us in theta. Short strangles allow for out the money short positions to be profitable without being too aggressive. An aggressive investor may use the profits from the strangle to roll the long position down to a higher delta. Not going to touch as much on that today, but we are going to talk on using the moving average envelope indicator. This indicator calculates a moving average of a specific type and shifts it above and below by a specific percentage. I'm going to show you exactly what that means. So type and percentage. Short strangles allow for out the money short positions to be profitable without being too aggressive. And once again, an aggressive investor may use the profits from the strangle to roll the long position down to a higher delta. So I'm going to jump out and jump into the Thinkorswim, And here we're looking at DVN, which is it's an energy stock. It pays a great dividend, and it tends to stay pretty range bound. And notice these two squiggly lines that I have above it, sort of channeling the price. That's our envelope. And I'm going to go into indicators to show you what you would just type in envelope here and it would come up. But if you look at the settings, whenever you see length on an indicator, it's going to calculate length based off of how many periods is in this box. So right now we have 10. We could change that to 20, 30, what have you. What you're really looking for in this setting is just something that makes sense alongside the underlying. So if you pull up this indicator and your underlying is staying in the channels, you don't have to mess with the indicator much. But if you pull up the indicator and the underlying is just going way beyond the channels, then you can sort of expand the indicator a little bit to try to see if you can get a better reading. So we're adjusting it to try to give ourselves a better, more accurate reading for how an underlying might trade. And so if we were to turn this into a weekly chart, then this length, instead of measuring 10 days, it would measure 10 weeks, monthly, 10 months. Hour, it would be 10 hours. All right. So it's always just counting the number of actual candlesticks that are printing. And all we're doing is taking that moving average and drawing a line for 10% above and 10% below. And that's what's creating our channel. And again, we could adjust that if we wanted to, but it's really not necessary here. So for today's example, I actually just wanted to go roughly a month back to kind of, because it actually fits pretty nicely. You can see that we're right in the middle of our channel if we sold on this day. And to just give an idea of what type of premium we would be looking at with a strategy like this. All right, so like I always do, jump into the Analyze tab, and I'm in the Think Back section. And I've already selected the 7th of November because that's lining up on the chart about a month back in trading from now. And what I figured we'd do is just target Friday's expiration. And so what I've selected is roughly the 10 delta on both sides. So you can see on the put side, had to sell an 11 delta because the six wasn't going to make all. You don't need to go that low. You can go to 10. And then looking at the same strikes, selling the 10 delta on the call side. And so you notice that we're getting a little bit over $1 credit. So we're actually getting, more than the cost of a share. So we're essentially accumulate. If this is successful, then after a month, we accumulate one more share to our position. That's one way to think about it. And then if we go into charts, you can kind of see these are the areas that we want to steer clear of for a strategy like this. This is an income generating strategy. This isn't supposed to be like a really sharp technical analysis. I'm getting in here, my stop is here, my target is here, and I'm trying to be really sharp. This is more of a rinse and repeat type strategy that should work to consistently generate income over time. All right. And so now just with a different drawing set, I've actually drawn in where those short strikes are. So you can see from a month out, just visually, this, we had a short at 86, we had a short at 59, and we are just fine. Like this is just a picture perfect type of a trade. Obviously, if we jump into Think Back and we put in today's date and we look at what those premiums are trading for, I would be very surprised if they're trading for anything, but let's see. Let's put in the 8th of December and see what it's looking like. So you can see the 59 is trading for 3 cents. And that's really the side that is borderline. It's not close, but it's borderline close. It's trading for 3 cents. And the call side is trading for nothing. Like it's complete. So this is the type of strategy that obviously we're looking at a successful version of it, but I don't think that anyone would look at this type of a strategy with this type of an indicator and feel like it's unrealistic to rinse and repeat a strategy like this. Does that mean that you'll never be in a situation where you have to manage it? Of course not. Trading is always gonna put us in situations where we take losses, but the overwhelming majority of the time, this is the type of strategy that we can rinse and repeat. Is it a massive premium? No. It's the type of thing that can compound over time. Absolutely. So that's why we're sharing it. The other reason why I'm sharing it and why I said that this is the last building block. So if we recall, when I was talking about selling short calls, I sort of went into the weeds at the end of one of my videos and started talking about not only turning them into credit spreads, but turning them into iron condors. This is the profit driver of an iron condor. The only thing that makes an iron condor different is that rather than being naked from an option standpoint, in an iron condor, on both sides, we would buy calls and puts to protect ourselves. So we would simply further out of the money, turn both sides, both the put side and the call side, we would turn those into credit spreads. And I think that we've talked about this before, but I just want to remind everyone, the idea of how wide you go is always going to be how much implied risk you're taking. There is study that needs to be done to understand how to mitigate risk if price is screaming towards you in a short position. We don't want to ever just be a sitting duck and let price tear up a short position of ours that's not responsible trading. But the idea is you set yourself up in these neutral positions. And if you don't own 100 shares of the underlying, or if you're trading something, quite frankly, that you're trying to be more aggressive on, but still want to iron condor with it, you can do this strategy and simply go long on either side. So I'm really happy with what we have in terms of the last few weeks of options instruction. We've talked not only about long calls and long puts, we've talked about the short version, and then we've talked about pairing them. If you combine this week's lesson and you also think about last week's lesson, you have the inner workings of both butterflies and condors. And so when we start to talk about those structures in the chat, or when you start to sign up for classes with Suzanne and she's trading them, it is not going to be a long leap or a long stretch to figure out that side of it. At this point, I'm actually going to start to wrap up tonight's call. I wanted it to be brief and to the point because I think that we've covered a ton of material. If there is anything that I said in this call that doesn't make sense, I would strongly encourage you to first and foremost review the short put call and review the short call, short call. But you want to have a really good understanding and a really good idea of what it means to be short. And through those, if you do that and then you bounce back to this, it's going to make a lot more sense. I'm looking right now, and I just saw Tamika let us know that you all actually couldn't see my my Thinkorswim, and so now I really believe that you can. I'm sorry for the communication, but we are back on. I'm going to just go over this one more time with the visual, and hopefully we can find a way to edit this out for the final version. But this. What I'm really thankful for is I kept tonight's class a little bit briefer, and so that means that when I go over this one more quick time and everybody can see the visuals, hopefully you guys are here, but when we can see the visuals, it won't be too bad. So I'm actually going to try to teach this with the assumption that people didn't see or hear what I just said. So if you did, you're going to get it one more time, but I'll try to be concise and to the point. So the idea, we're looking at DVN, and I really believe that you all can see it this time. And we are using the moving average envelope. And using the moving average envelope, it's set to base it off of 10 periods. So that means we're looking at a daily chart, so it's 10 days. If we were looking at a weekly chart, it would change its structure, and it would base it off of 10 weeks, hour, 10 hours, so on and so forth. But it's going to take that moving average and give us a projected percentage above and a projected percentage below, and that gives us this channel. And what we are hoping to do is or really what we're thinking is generally price should stay within that channel. And if we sell outside of that channel, then we should set ourselves up for success. If we sell while price is trading close to the center of the channel, then it gives us just a better timing, because what we're saying is like, okay, price is probably going to try to go to one side of this channel or the other, but it's got to take some time to get there, which I'm going to be benefiting from. And while it's moving towards in one direction, like if it's going higher, then my put side is really benefiting because I'm short puts. If it's going lower, then my call side is really benefiting because I'm short calls. So the idea is not necessarily to try to sell it at the extreme of the channel, but to sell towards the center of the channel. The example I came up with is from a month back. And so you'll see that when we look into think back, it would be assuming that we're looking on this day, the 7th of November. So as always, jump into analyze. Let's type in and do I still have these strikes highlighted? I don't. Let me just highlight the strikes one more time. We're looking at an expiration that from that month back is now tomorrow. It's Friday's expiration. So a little confused. I feel like I was looking at a little bit juicier premium, but that's okay. We're going to work with it. Instead of selling the 8 delta here, I'm not sure what I was looking at before. Instead of selling the 8 delta here, we're going to go a little bit tighter to the 17. And we're going to go, something doesn't look right here. Huh. This is, sorry, everybody, bear with me. This just looks very odd, and I've got to figure out why. I wonder if I looked at a later. The thing that I'm noticing here, it's a little disappointing for this example. Notice that, wait a second. Yeah, so just notice that the premiums that we're looking at on this side of the chain, I've never seen ThinkBack do this, but it just doesn't make sense. So I'm actually going to for this, it's disappointing for this example because normally when I look at think back, it gives me data that seems reasonable. A month out to have, just out of like just above current price, a call sell for 11 cents just doesn't make sense. We're not looking at proper premium. And then you notice on this side, everything is $1. It just doesn't add up. So I'm gonna have to kind of break through this part and but go to the chart and kind of show you what I was looking at. When those premiums were printing prices that seemed like they made more sense, on this day, on the 7th, I was looking at selling up here at the 86, selling the call side. So being short a call 30 days out at $86 and being short a put at $59. And the premium that I was looking at the time was a combined about $1. So we weren't looking at getting like an insane premium, but we were looking at getting a reasonable premium for those strikes. All right, so we're just going to proceed with that in mind. And the point that I was trying to make was you sell about a month out and you're selling a 10 delta. You're doing something that hopefully you can rinse and repeat, and something that that you can use to income generate. If you're collecting about $1 premium on an underlying that's not trading for $100, then you're well above essentially just channeling in another share every month that you do a strategy like this. So if you're working on accumulating shares with the purpose of collecting a dividend, this is a great strategy for doing it. The other idea that I wanted to present was just the concept that this is the inner workings of an iron condor. That essentially, if I'm selling an iron condor, I'm doing the same thing. I have a short strike above and below current price, and I'm trying to strategize it in such a way that I'm collecting a premium that's worth me putting on the risk, but it's still a very high probability that price is not going to challenge either my short call or my short put. The only difference is with an iron condor, you're going to also buy long positions outside of your short positions. So with an iron condor, you're short the 59. You could buy a less expensive at maybe the 49. Same thing with the 86, you're short the 86. You buy a less expensive call, like a really, really not expensive call at about 96. If any of what I'm just describing here feels a little bit confusing, really want to encourage you to jump back into when I was discussing short calls, when I was discussing short puts, because understanding short calls, understanding short puts, if you have a great understanding of that, then it's really pretty intuitive to start thinking about being short a call and being short a put at the same time. And again, if you're short a call and a put on the same expiration, you can only be wrong in one of those directions. So the margin is you're going to collect a premium based off of both of those positions, but the margin requirements is only going to be based off of one position. Now, obviously here, unless you're holding 100 shares, you're going to have a massive margin requirement to be in a trade like this. But if you turn it into an iron condor, if you're 10 points wide, an iron condor, that is the amount of risk that you're putting up. It's $1,000. So that's still a type of a trade that you can learn to do with a strategy like this. To everybody who stuck it out and heard both parts of this presentation, I really appreciate it. The first part of the technical difficulties was 100% on me, so I apologize for that. The second part of the technical difficulties, I don't know what happened. That's Thinkorswim. They're gonna have to own that one. So I do apologize for that one as well. Thank you to everybody for your patience. As always, I really appreciate comments, really appreciate questions. always reach out in the chat. It's always great talking to everybody. And Tamika, thanks again for for letting me know that that you all weren't seeing my screen. So I apologize for that, and everybody have a great night.